Have you ever just stopped and wondered how a massive, sprawling entity like a government actually manages the incredibly complex machine of an entire national economy? I mean, from the outside looking in, it just looks like pure chaos, right? You've got millions of independent businesses doing their own thing, billions of consumers making daily choices, and these constant, totally unpredictable fluctuations in prices and jobs. But what if we looked at the economy not as a chaotic mess, but as a giant aircraft? And more importantly, what if the government is actually sitting right up there in the cockpit, actively flying it?
Welcome to This Explainer. Today, we are stepping straight past the cockpit door and into the economic control room. We're going to view the government exactly like a pilot, sitting right in front of a massive dashboard, pulling very specific, deliberate levers to navigate the economic skies. And this pilot's primary operating manual? Well, it's called Fiscal Policy. By the end of this, we are going to completely demystify exactly how these super high-level government decisions actually end up trickling down to impact everything in our daily lives, from that crazy inflation we've all been seeing at the grocery store, right down to the availability of well-paying jobs in our own local communities.
All right, let's look at our flight plan for today. We'll start with number 1, the government budget. 2, understanding taxation types. 3, expansionary fiscal policy. 4, contractionary fiscal policy. 5, deficits and surpluses. And finally, 6, evaluating fiscal policy.
Okay, jumping right in. Section 1, the government budget. So every good pilot needs a flight plan before takeoff, right? Well, for national economies, that blueprint is the government budget. It's the master plan that tries to balance out revenue with expenditure. And this brings us to the absolute core definition of our explainer today, fiscal policy. Basically, fiscal policy refers to the deliberate decisions a government makes regarding its spending and taxation, specifically designed to influence what economists call aggregate demand. Think of aggregate demand as the total engine thrust. It's the combined total demand for all goods and services inside a country. To actually steer this demand, the government relies heavily on two main levers sitting right there on the console, the spending lever and the taxation lever. Let's look closely at that first lever. Public expenditure, or government spending, acts literally like high-octane fuel injected directly into the economic engine. And here's the thing, the government doesn't just spray this money around randomly. It targets highly specific societal and economic goals. For starters, it funds essential public services just to keep the country running smoothly. It also actively redistributes income, essentially taxing wealthier folks to fund support programs for lower-income households, which helps narrow that opportunity gap. Plus, it subsidizes what we call merit goods. These are things that benefit society as a whole, like public education and healthcare. And finally, because we live in a super competitive global economy, the government pumps capital into strategic industries, these national champions, to make sure the country stays secure and highly competitive on the world stage.
Section 2, understanding taxation types.
Of course, to inject all that high-octane fuel into the engine, you first have to collect it somehow, and that brings us to the second main lever on the console, taxation. Now, taxes generally fall into two distinct buckets. On one side, we have direct taxes. These are levied directly onto people or entities. Think of your individual income tax, corporate tax, or property tax. The key takeaway here is that they are non-transferable. If you are taxed, you bear that burden directly. But on the other side, we have indirect taxes. These are levied on goods and services. The crucial difference? They are transferable. The supplier officially pays the tax to the government, sure, but they essentially just pass that cost straight on to you, the consumer, by quietly baking it right into the final price tag of whatever product you're buying.
To really ground this abstract idea in reality, let's look at a massive real-world example, 19%. That was actually the value-added tax, or VAT, rate across the European Union back in 2022. VAT is the classic example of an indirect tax. It gets applied at practically every single stage of the supply chain. But ultimately, when an everyday consumer goes to buy a product, that 19% is completely and seamlessly embedded into the price they pay at the register. You are paying the tax, even if you don't really realize it's happening.
Now, tax systems are generally classified as progressive, proportional, or regressive. Direct taxes, like your income tax, are usually progressive. That simply means as your income rises, you pay a larger percentage of your income in taxes. The burden naturally falls a bit heavier on high earners. However, indirect taxes, like that 19% VAT we just talked about, are strictly regressive. Why is that? Well, think about it. Everyone pays the exact same absolute tax amount on a specific product, regardless of how much money they have in the bank. So taking $50 in tax on a purchase represents a much, much larger percentage of a low-income earner's total wealth compared to a millionaire buying that exact same item.
Section 3. Expansionary Fiscal Policy.
Okay, so now that we fully understand our two levers, spending and taxation, let's look at our very first dynamic action in the control room. Imagine the economy is stalling out or losing altitude, maybe entering a recession. The pilot has to aggressively push the thrust lever forward. Economists call this expansionary fiscal policy. The government will ramp up expenditure. They'll cut taxes, or sometimes they'll just do both at the exact same time. The goal here is incredibly simple and highly urgent. Get purchasing power back into the hands of everyday businesses and households. By cutting taxes, you and I have more disposable income in our pockets, and by spending more, the government directly creates demand for goods and services, which jumpstarts consumption and hopefully brings unemployment down in a hurry. To show you just how aggressively this lever can actually be pulled, consider this staggering number: 100 billion Singapore dollars. That was the size of the massive stimulus deployed in Singapore back in 2020. During the absolutely devastating economic shock of the COVID-19 pandemic, the Singaporean government injected this incredible sum straight into their economy. They provided really high-wage subsidies specifically for the food, beverage, and frontline service sectors that were basically forced to halt their operations overnight. This absolutely unprecedented wave of government spending directly prevented those specific sectors from just completely collapsing, allowing them to survive the lockdowns and eventually recover.
But the true magic of expansionary policy lies in this incredible chain reaction known as the multiplier effect. Let's trace the dominoes here because it's fascinating. When the government spends a chunk of money, say they decide to build a massive new hospital, the construction workers building it suddenly earn higher disposable income, right? Now, for every additional dollar those workers earn, they go out and spend a fraction of it on other goods and services, maybe treating themselves at local restaurants. Economists actually call this their marginal propensity to consume. Then, those local restaurant owners earn more income, which they, in turn, take and spend somewhere else in the community. Because of this cascading, ongoing chain of consumption, the final total increase in the country's real GDP ends up being far, far greater than the initial amount the government spent to build a hospital. It literally multiplies.
Section 4. Contractionary Fiscal Policy. But what happens when the aircraft is flying a little too fast? Sometimes an economy runs completely red hot. Total demand severely outpaces what the economy can actually supply, and that causes prices to just absolutely soar. It's a highly dangerous situation that we all know as inflation. To combat this, the pilot actually has to use contractionary actions to hit the brakes. They do the exact opposite of everything we just talked about. They aggressively cut government expenditure and they raise taxes. Now, I know it seems completely counterintuitive for a government to intentionally try and slow down economic growth, but sometimes it's necessary. This deliberately drains purchasing power right out of the economy, forcing consumers and businesses to spend less, which ultimately cools demand and brings those crazy prices back down to earth. So, pulling these two distinct levers yields completely diverging impacts. Let's recap. Expansionary policy increases purchasing power, it boosts consumption, and it drives up aggregate demand. But we have to remember, it carries a very dangerous risk of triggering inflation if they leave the thrust on for too long. Contractionary policy, on the flip side, deliberately reduces purchasing power and aggregate demand. Sure, it slows down overall economic growth, and it might even bump up unemployment a little bit, but it's widely considered to be the necessary, sometimes very bitter medicine required to keep runaway inflation in check. Section 5. Deficits and surpluses.
Now, with our pilot constantly pushing and pulling all these levers, we definitely need to regularly check the warning lights and fuel gauges on our dashboard. An exactly balanced budget where the money coming in perfectly matches the money going out is honestly incredibly rare in the real world. Usually, a government runs either a deficit or a surplus. A budget surplus happens when the government collects more in revenue than it actually spends. This is great, providing extra capital to fund massive long-term infrastructure projects or to build up safety reserves for future economic shocks. A budget deficit, however, means the government is spending more than it earns, and to actually finance this really expensive flight, the government is forced to go out and borrow money by issuing public debt. Now, running deficits for a little while is normal, but running persistent, massive deficits can actually trigger a really critical side effect known as crowding out. Here's how it works. When the government needs to borrow huge amounts of money to cover its deficit, it creates massive demand in the financial markets. Naturally, that huge demand drives up interest rates across the wider economy. Suddenly, regular private consumers and businesses find that getting a loan to, say, buy a house or expand a local factory has just become unbelievably expensive. So what do? They reduce their borrowing and their investment. Essentially, the government's massive, heavy footprint in the loan market physically crowds the private sector out, completely inadvertently stifling the very economic growth the government was probably trying to encourage in the first place.
Section 6. Evaluating Fiscal Policy.
We have covered a whole lot of ground in our economic control room today. But we have to ask, how effective is the government's ability to steer this massive machine in the real world? Well, a major strength is that government spending can be highly targeted. Unlike just tweaking interest rates across the board, the government can aim at spending directly at struggling industries, like we saw with the food sector in Singapore, and it generally has a much shorter time lag to take effect. But the weaknesses are very real too. Human psychology plays a huge part. If consumer confidence is low during a crisis, a scared, pessimistic public will probably choose to save their stimulus money under the mattress rather than spend it. That drastically shrinks the marginal propensity to consume, totally neutralizing that magical multiplier effect we talked about. Plus, fiscal policy is always at the absolute mercy of shifting political winds. A vital long-term infrastructure project might suddenly lose all its funding simply because a new political party takes office.
And that actually leads us to one final, really provocative question to close out our explainer today. We absolutely know that aggressive expansionary policy and deficit spending can literally save a stalling economy from disaster in the short term. But does today's deficit spending create a massive opportunity cost that ultimately leaves a crushing, maybe impossible national debt burden for future generations? Think about it. If a government completely drains its reserves or balloons its debt to fix today's problems, what happens when the next massive crisis strikes tomorrow? Who ultimately is going to end up paying for this flight? It's a super heavy question for sure, but it's exactly the kind of question that every single economic pilot has to weigh every single time they reach for those levers. Thank you so much for joining me in the control room today.